Luke, welcome to New York. Let's just begin by getting your thoughts on Treasuries. A bid to close out the week, but kicking through some key levels through the week so far.
Yeah, and this is this debate about how far over 3% we can sustain.
Yeah,
we blew through all the support levels, 303 itself and 305, and hit 310, almost 311. It's kind of a bit irrelevant in a way what the level is, but the direction's for a little bit higher, I think. So the fact we've been a bit of bid at the end of the week, this might be about Italy and the US being a safe haven.
Interesting,
right?
interesting.
But the spread versus Germany, which I've got on my terminal here, it's still at really high levels, really, really high levels, and it's going to get higher yet.
Yeah, Diana, to Luke's point, we took out the 2018 high, we took out the 2014 high, and I just wonder, when you look at this spread over Germany, when the Bund Treasury spread blows out beyond 300 basis points, how much wider can it get? And can the United States and the Treasury market really decouple from the rest of the world?
It can certainly get wider. I think what's important to keep an eye on is what's going on with the underlying European growth and inflation outlook. This quarter, we have very disappointing growth out of Europe relative to where we've been in the last few quarters. The ECB had to downgrade some of their language around growth. There are transitory things that might be explaining this. Some of that is weather related, but ultimately, we're not seeing inflation coming through in a meaningful way. So when you add that to perhaps a bit of a flight to quality on what's happening on the periphery with Italy, it's possible to see that spread widening further. Your thoughts?
Yeah, I think that's a very good point that was just raised. It's sentiment around the problems out of Italy, although we think they're fully priced into the market, will definitely bring in those European yields considerably. And the differential, the relative differential to U.S. growth is really pronounced at the moment.
Joe, we've had these discussions multiple times, but the difference this week, I think, is the shape of the curve. A lot of people looking for a flatness of the curve. This week, steepness started to come through. It's a one-off week, fine. But what are your thoughts about the direction of that? It was the spread between 2s, 10s, narrow, 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 and surely it gets flatter. And then this week it changed. Why?
Yeah, fair point. In my view, it's really just a sign that the U.S. growth, underlying growth, is strong and probably getting stronger as we see Q2. And that's what we're seeing with the long end. More confidence there.
Luke, 30-year yield was like the last man standing on the Treasury curve. This week something changed. The curve got steeper as well. What are your thoughts?
Yeah, so I'd agree with Joe. I think the front end steepens up again here from here. We're 50 on at the moment. We can get back into this kind of 80 odd context quite easily. And it's about the US growth story. Long end of the curve, I think it's going to be actually looking past this a little bit, starting to worry about the 2020s and growth slowing down.
What is it about the 2020s
I know.
everyone's starting to think about more?
And if we're all thinking about the 2020s, why are we not doing something about it now? It's about Trump tax, it's about the stimulus bringing forward growth and when we could see the next problems coming up. And I agree, it's a bit too common now, the 2020. I think actually it won't be a recession, it'll just be a bit of slow growth for a while.
Dana, I hear this all the time, especially with the equity markets and investors there, and then fixed income much more so too now. This obsession between what happens now is going to be fine, but then wait for 2019, 2020. Then you've got to start pricing in a slowdown. Do you subscribe to that argument, Diana?
I think eventually we will have to price in the slowdown. I think the reason why the market says right now we're focused on here is there's just too many moving parts to this story. So the impact of the fiscal stimulus we've seen in the US is only now starting to come through. That could possibly push this into 2019. What happens beyond that when we are at a point in the cycle where monetary policy is going to be significantly tighter, I think is a big question mark.
Well, Joe, the question here at the moment as well is the market getting ahead of the Federal Reserve in terms of projections for interest rates. It is like this small, but it's happening in a way it hasn't happened for several years. The market is forecasting more rate hikes than the Federal Reserve themselves are projecting. What's the signal you take from that? Yeah,
it is, right? I think the markets are concerned about higher oil prices, no doubt. The geopolitical risks are raised, as we're aware. And that could have significant cyclical and lead into more secular inflation growth.
Is it an oil story for you, Luke?
I'm not convinced it is. I think actually, you know what, the dollar's doing some of the monetary tightening for the Fed anyway. Fiscal conditions are tightening. Doesn't matter whether you're looking at the Bloomberg index or the Goldman Sachs index, they're tightening up in the US. So, I think you get 2 and 2 this year, 2 next year, not 3 and 2. And the market's starting to take the pricing out of that third one now. You know, we're now 2.5 and 2 in the WIRP. But, you know, I think 2 and 2's at the most here. And the Fed, I think, is at real risk of just going too far too soon.
You really think so?
Yeah, I do. Jay Powell, just to me, he looks an uber hawk.
Does he really? What gives you the
I mean,
indication that Jay Powell's a hawk?
Just the rhetoric we've had out of him since he got appointed, a month and a half, 2 months ago.
Yeah.
He wants to get up the hill, right? He's a grand old Duke of York. He wants to go marching up that hill with rates, so he's got some room to get down the other side. And I just think he's going to continue down that path. And the risk is it just too much, and that could be where we get 2020 as our problem area.
That's
right?
really interesting because, Diana, as far as I'm concerned, real rates are still negative at the Federal Reserve. This is still an accommodative Federal Reserve, isn't it?
Yes, it is, but I think that's the point that's just being made. That raises the likelihood that you do get more hikes. The Federal Reserve is obviously very cognizant that we have had this unprecedented stimulus at a time when the labor market is quite tight. They don't want to be caught behind the curve, but they want to steer the language that way. I think the next two meetings, it's important to see what happens with the dots.
Yeah.
Our view is we expect the median dot to actually signal one more hike this year. So we agree with the camp that you get 3 hikes this year and possibly another 3 next year.
Joe, just before we go, do you like real yields at 90 basis points?
Yeah, I think so. At shorter ends of the curve, the yields are attractive, not so much at the longer end.